If you're a CRNA or nurse practitioner making more than $150,000 a year and you're over 50, the IRS just took away one of the biggest tax breaks in your retirement plan. Not reduced it, took it away. Starting this year, your catch-up contributions, the extra money people 50 and older get to put in on top of the normal 401k or 403b limit, cannot go in pre-tax anymore if your wages cross that $150,000 line. Every dollar of it now has to go into a Roth account after tax, whether you want it to or not. And here's the part that gets me. Almost nobody in this field has adjusted their plan for it. Most CRNAs and nurse practitioners I talk with are still doing exactly what they did last year because they're assuming the math is the same. It isn't. So let's walk through what actually changed, why it costs some of you real money if you ignore it, and then the part worth sticking around for, a couple of pieces that most people in this field don't even know exist that can end up putting you further ahead than you were before the rule ever changed. Now, before we get into the mechanics, here's why I think this is worth 20 minutes of your attention instead of just skimming past it. Most CRNAs and nurse practitioners I work with didn't get into this field chasing a number. They got into it to take care of people. And somewhere along the way, the schedule, the call shifts, the emotional weight of the job, it all starting costing more than they expected. So the retirement account isn't just a pile of money sitting somewhere. It is the thing that eventually lets you say no to an extra shift or cut back to part-time, or ultimately to walk away from a facility that's grinding you down on your own timeline instead of someone else's. A rule change that quietly shrinks how much of your savings actually compounds for you without you noticing pushes that timeline out further than it needs to be. And that's really the stakes here. It's not really about the tax code. It's about whether you get to make work optional a year or two earlier or later than you otherwise would have. Okay, so first, the basics. This is what's called the Mandatory Roth Catch-Up Rule, and it comes out of the Secure 2.0 Act. For 2026, if you are 50 or older, you can put $24,500 into your 401k or 403b as a normal employee deferral, plus a catch-up contribution on top of that. Now, for most people 50 and older, the catch-up is $8,000, bringing the total to $32,500. Now, that part hasn't changed. What has changed is where that catch-up piece is allowed to go. Here's the new rule. If your FICA wages, the wages your employer reports on your W-2, were $150,000 or more in the prior year, your catch-up contribution has to be Roth. Pre-tax is off the table for that piece. It doesn't matter if your plan offers a pre-tax option for everything else. The catch-up dollars specifically have to go in after tax. And this is based on wages from the specific employer sponsoring the plan. So it's not your total income across every job. It's what that one employer put on your W-2. So why does this matter? Because for years, the advice for high earners was simple. Put as much as you can in pre-tax so you can lower your taxable income today, let your account grow, and deal with taxes later when hopefully you're retired and maybe in a lower bracket. That was the whole strategy for a lot of CRNAs and nurse practitioners, stacking up savings in their peak earning years. Now, for the catch-up piece specifically, that option is gone if you're over the wage threshold. So if you just keep contributing the way you always have without checking whether your plan even offers a Roth option, you could actually lose the ability to make catch-up contributions at all, because if your plan doesn't have a Roth feature, well, then it can't accept the catch-up money in any form. So let's talk about what this actually costs in real terms if you don't adjust anything. So say you're used to putting in that $8,000 catch-up in pre-tax. Again, under the old rules, that $8,000 came off of your taxable income for the year. Under the new rules, it doesn't. And if you're in the 32% federal bracket, which covers a lot of dual income households and people like high earning individual CRNAs in this range, well, that's roughly $2,500 or more in taxes due this year that would not have been due last year on that one piece alone. And if you're stacking catch-up contributions across two plans, so say you have a 403B and a governmental 457B, and you just default into Roth on both without checking your options, well, obviously that number can roughly double. That's real money due next April that used to just sit there deferred. And here's where the behavioral piece comes in, because I see this a lot. It's not a knock on anyone. Most retirement plan contributions just run on autopilot. You set it up once, probably years ago, and payroll just keeps doing the same thing for you every pay period until you actively go change it. Now, that's actually usually a good thing because inertia keeps people saving instead of second guessing themselves every paycheck. But it also means that when a rule changes underneath you, nothing forces you to notice it, because payroll will just start routing your catch-up into Roth automatically once your plan updates its system. And believe me, you won't get a phone call about it. You're just going to see it, or maybe not even see it, on your pay stub. So the mistake isn't really a financial one. It's an awareness one. It's letting a system built for consistency also make a decision for you that you never actually looked at. And now here's the part I actually want you to walk away from this episode with, because this is where it gets interesting and where most of the generic advice out there stops short. Most CRNAs and nurse practitioners have access to more than one type of retirement account, and most of them treat those accounts like they're all in the same bucket. They are not. A 403B and a 457B are separate plans with separate limits. Now, the IRS does not make you choose. You can max out the employee deferral in your 403B and separately max out the employee deferral in your 457B in the same year, because those limits do not share a cap the way, say, that two 401ks at two different W-2 jobs would. So if your hospital system offers both, and a lot of them do, you are potentially looking at two full buckets of tax advantage savings instead of one, just by using what's already sitting there in your benefits package. And there is a second piece that almost nobody in this field knows about. 457B plans have something called a special catch-up provision. It's sometimes called the final 3 years catch-up. Now that's separate from the regular age 50 catch-up. If you are within 3 years of your plan's stated normal retirement age, and you have historically contributed less than the max in prior years, your plan may let you contribute up to twice the standard deferral limit in a single year, so up to $49,000 in 2026, to make up for that unused room. Now, you can't use this special catch-up and the regular catch-up in the 457 in the same year. It's either one or the other, whichever lets you put in more. But here's the detail that matters most for the conversation we're having now. Under the final regulations, this special 3-year catch-up is treated differently than the regular age 50 catch-up for purposes of the Roth mandate. The portion of it that falls within the special catch-up limit can still go in pre-tax, even if you're over the $150,000 wage threshold. Only the amount that would have counted as a normal age catch-up layered on top of it has to be Roth. So for someone in their final 3 years before their plan's retirement age, this can mean access to a meaningfully larger pre-tax contribution than the regular catch-up rules would otherwise allow. And then there is a third piece, and this one's specific to anyone doing 1099 work on the side, which frankly describes a lot of CRNAs picking up locum tenens contracts or nurse practitioners doing part-time consulting. If you have any self-employment income, you can open what's called a solo 401k. And because self-employment income isn't FICA wages, the $150,000 Roth mandate that we have been talking about does not apply to it in the same way, since that rule is tied to wages reported by an employer, and a sole proprietor doesn't have an employer reporting FICA wages. More importantly, a solo 401k lets you make an employer-side contribution on top of whatever you're already doing with your employee deferrals elsewhere. Again, it's based on your net self-employment earnings, and that's a separate pot of money, generally pre-tax, that is subject to its own overall limit, which for 2026 is $72,000 in combined employee and employer contributions to that plan. Now, if you've already maxed your employee deferral through your W-2 job, that employer side solo 401k contribution is still available to you because it's funded entirely by your 1099 income. So when you put those three things together, the 403b, the 457 with its special catch-up option, and a solo 401k for any 1099 income, you're looking at a structure that can shelter meaningfully more than the generic just max your 401k advice that most people get. And it's not a loophole. It's just using the accounts that already exist the way they're actually designed to work. Let me walk through what this can look like for someone in your field, because the numbers are more concrete than most of what gets talked about on this topic. So this is a hypothetical example. It's not a real client, but the mechanics and the math are accurate to how these plans work. Say there's a CRNA, and for today we will call her Dana. She's 51. And Dana works a W-2 hospital job that gives her access to a 403b and a 457b. And she also picks up some 1099 locum tenens work on the side. So between the two, she's earning around $230,000 a year. She's got just over $1 million saved so far. Now, her hospital wages alone put her over the $150,000 threshold. So under the new rule, any standard age 50 catch-up contribution that she makes to either her 403b or her 457 has to go in as Roth starting this year. So here's the trade-off that Dana's facing. And it's really the question at the center of this entire episode. Is it worth restructuring how she has been contributing for years just because of one rule change. Now, for a lot of people, the instinct is to just accept the Roth treatment on the catch-up and move on because it's frankly a lot easier. And honestly, for some people, that is a good answer. Roth money isn't a bad outcome. Again, it grows tax-free and it gives you flexibility later. But if Dana just defaults into that without looking at her other options, she's leaving structure on the table that has nothing to do with Roth versus pre-tax and everything to do with which accounts she's even using at all. Now, she's also busy, which is worth naming honestly because between hospital shifts and locum contracts, Dana isn't spending her evenings reading IRS notices, and there's no reason she should have to. That's really the whole point of walking through this. Not that every nurse practitioner or CRNA needs to become an expert in 457 catch-up provisions, but that knowing these pieces exist is what makes it possible to ask the right questions at the right time instead of just assuming the default setting in payroll is the only setting available to you. So here's roughly how it plays out for Dana, structured properly. She keeps maxing her 403B employee deferral. The standard limit plus catch-up, same as before. Just now, with the catch-up is going in as Roth since she's over the wage threshold. Separately, because her 457 doesn't share a limit with her 403B, she funds that account too. And because she's now within a few years of her plan's stated retirement age, she's got unused room for lighter contribution years earlier in her career. So her 457 allows her to use the special 3-year catch-up instead of the standard one, which under the final regulations means a meaningful piece of that contribution can stay pre-tax. And on top of that, she runs her 1099 locum income through a solo 401k and puts an employer side contribution in from that income on top of everything that she's doing through her W-2 job. So let's put a number on it. If Dana does what a lot of generic advice tells her to do, again, just max the 403B and call it done, well then she's putting in $32,500 a year with the catch-up included. And that of course is a solid number, and it's better than most people actually manage. But if we structure this across all three accounts, the 403B, the 457 with its catch-up option, and then the solo 401k funded by her 1099 work, she can reasonably put somewhere around $40,000 more per year into tax-advantaged accounts than that single account approach would allow. Assuming a hypothetical 7% average annual return, which is an assumption for illustration and not a promise of what markets actually do, that extra $40,000 a year that's contributed consistently for the 14 years between her age now and age 65 adds up to somewhere around $900,000 of additional account growth over that period. So her million today, left completely alone with no further contributions at all, would grow to roughly 2.7 million by age 65 under that same hypothetical return. But if she structured it the way that we just walked through, she's looking at something closer to 3.6 million. And that's the gap between reacting to a rule change by just accepting whatever the default does to you and actually understanding the accounts that you have access to. And I want to be clear about something because it matters. None of this is about avoiding taxes forever. Some of what Dana's doing still ends up in Roth, and that's fine. That money just grows differently. What this is about is not leaving structure on the table out of not even knowing that it exists. So the question really isn't whether Roth or pre-tax is better in the abstract, because it depends on your bracket now versus what you expect later, and frankly, nobody knows what the future is with any certainty. So the real question is whether you are using every account you actually have access to or just the one that's easiest to think about. So here's the practical step if you take nothing else from this today. Pull up your most recent pay stub or your prior year W-2 and check your FICO wages against that $150,000 figure. If you are over that line, call your plan administrator. Do not call a generic call center number, but the actual person who handles your specific plan, and ask them two things. First, does my plan offer a Roth option? Because if it doesn't, catch-up contributions may not be able to go in at all this year. And second, if I have a 457B, am I within 3 years of the plan's stated normal retirement age? And if so, do I have unused contribution room from prior years that would make me eligible for the special catch-up provision instead of the standard one? And if you've got any 1099 income on the side, even a small amount, ask whether a solo 401k makes sense for you, because that employer side contribution is often sitting there completely untouched. Now, when you've got your plan administrator on the phone, it is worth asking a couple more things too. Ask what your plan classifies as your normal retirement age for purposes of the 457, since that's the date the final 3 years that catch-up counts back from. And it's not always the same as when you actually plan to retire. So ask whether your plan tracks your unused deferral room from prior years automatically, or whether you need to request that calculation yourself, because some plan administrators only will run it if you ask. And if you are self-employed on the side, ask your tax professional, not your plan administrator, how much net self-employment income you would need to justify setting up a solo 401k in the first place. Since there's paperwork and some ongoing administration involved, it should make sense for your actual numbers, not just to sound good in theory. So this rule change caught a lot of the retirement plan industry a little flat-footed too, honestly. A lot of plan administrators are still updating their systems and their paperwork for it. So don't assume that your plan has this all sorted out automatically. Ask directly and get it in writing if you can. And give yourself enough runway before the year end to actually make the adjustment instead of finding out in April of next year that the default happened without you. So that's really it. One rule changed very quietly, and it happened to land right on the group of people who have spent years building strong careers and strong savings habits without necessarily having the time to track every provision buried in a piece of federal legislation. Again, that is not a knock on anyone. It's just the reality of being busy and good at a demanding job. And I'll say this too, because I think it matters more than the dollar figures. None of this is about squeezing out every last percentage point of tax efficiency, and it's definitely not about perfection. It is about awareness. A financially healthy person in this field does not need to memorize the tax code. They just need to know enough to ask their plan administrator the right questions maybe once a year, and especially this year when the rules have actually moved. So that's a realistic bar. It's not about doing everything right. It's about not letting a quiet rule change make a decision for you that you never actually chose. The accounts you already have access to, the 403b, 457, solo 401k, if you've got 1099 income, they have not changed. What changed is which piece goes where. And that's worth 20 minutes with your plan administrator's time before the year runs out. I'm Brett Fellows with Oak Capital Advisors. We work with CRNAs and nurse practitioners 45 and older with $750,000 or more saved. If you'd like help modeling your own retirement timeline, including your catch-up contributions, where they should go, or what a solo 401k might do for you, and whether tax planning makes sense in your situation, schedule a conversation through the link in the show notes or directly at connectwithbrett.com. It's a free pre-op assessment, about 30 minutes, and it starts with your actual numbers. Until next time, take care of yourself and take care of your money.
This podcast is for informational and entertainment purposes only. It should not be relied upon as a basis for investment decisions. This podcast does not engage in rendering legal, financial, or other professional services.